Just hold on for a moment.
Hmm.
My coffee machine has suddenly. Okay, we can start.
All right. Okay. Hi, and welcome to a brand new episode of ET World View, where we talk about world markets and Indian markets along with much more. I'm Neha Vashisht Mahajan, and today I have Mr. Abhishek Banerjee with me. He's the CEO and founder of Lotus View Wealth, which is a SEBI registered RIA that gives stock basket recommendations combining macroeconomic analysis with micro cap stock selection. Thank you so much, Mr. Abhishek, for joining us on ET Markets live stream today.
Thank you very much, Neha, and thanks for the opportunity.
Well, the pleasure is all mine. So, before we get to the worlds, let's start with India first. I want your remarks on budget 2024. How was it in a nutshell for markets and investors?
So one thing I wanted to mention is the most important thing is STT, right? There are two things which are
Hmm.
happening. One of the things that we as brokers know, but the retail investor will know soon, is that the currently the price increases in individual stocks are about 5 paisa apart for various. The next price is 5 paisa away. So there are about
Hmm.
there's some stocks which are priced less than 250, where the price movement will happen at 1 paisa going forward. So that
Hmm.
means that the prices will be much closer to each other, and the STT has doubled. So what this really means is that the typical arbitrages that you could do with high frequency trading, where 5 paisa move on a small stock with high volume would still pay out with the STT implied. Those mechanics might get disturbed, which actually affects the way, let's say, market making works on smaller stocks. So that's first point. Second point is that if you look at the long-term capital gains tax for listed equity, it's just 25% more, like from 10 to 12.5. So that is obviously, nobody likes taxes. It's a negative, as straight as it is. But
Hmm.
if you look at the real estate part, right, where they have also
Hmm.
allowed long-term real estate to be taxed at 12.5% instead of
Yeah.
20% with indexation. It's also going to be pretty taxing, because let's do the mental math, right? Let's say if you were to the long term is applicable for after 2 years of holding period. Let's say we do a
Hmm.
3 year holding period of real estate. Now, typically inflation or CPI in India, we have been printing slightly above 5, right, so far.
Hmm.
Now, if you bought something at 100, after 3 years it will be priced at 118, right?
Hmm.
So therefore what you would, so let's say after 3 years you sell the property for a 20% appreciation, you would be
Hmm.
taxed only on the 2%, 20% of 2% or 0.4%. Whereas now
Hmm.
what will happen is that because you don't have indexation, the same property sold after 3 years at 120, 12.2%, 12.5% of the 20%, which works out to be roughly, I think it's roughly about 5%. So you see there's a
Hmm.
10 times to a 15 times increase in the taxability of that same transaction. So these two
Hmm.
things will basically mean a couple of things. First is people will become more long term oriented, because long term
Yeah.
capital taxation is deferred taxation. So until you transact, there is no taxation, which means that
Hmm.
the money that has come into market will become more sticky. Yes, that's point one. Second
Hmm.
point is that because short term kind of stocks, short term capital gains tax has increased by 30% from 15 to 20%. That
Hmm.
means that, and SEBI has come out with a report yesterday that also says that 70% of the investors who do intraday equity trading, they lose money. So
Yeah.
with this higher barrier, I think what they're trying to say is that it's not really in the best place for you to earn money. Why this they are
Hmm.
so much after this particular aspect is, the reason is that typically it is true that traders on an average lose money, right? And this money could have been spent in consumption, like buying sort of some consumer discretionary items. So if people continuously lose money in markets, and we don't know who is, and of course the regulator knows, but we don't know who is earning it back, right? It might not be a
Hmm.
entity based out of India, or it might not be a person based out of India. So if there's a continuous impoverishment of the participants of the market participants, because they're not skilled enough to make money in intraday and derivatives, it is in the nation's best interest that you remove some of that access, because it basically means that that money is going away from the country. So therefore, on these two aspects, right, and it's become a macro issue, it's become an issue of taxation. But at the end of it, the positives out of this really is that
Hmm.
going forward, it's simplified. Obviously, you don't have to apply different mechanics for different asset
Yeah.
classes. And second thing is, because of higher barrier of taxes, the money will be more sticky, which gives a stronger base of from where the markets can further grow. So that said, I'm still quite bullish about long term process, because the money cannot now exit that easily, right? And therefore, with more and more SIP money coming in, I think it's just a liquidity feeding into the existing stocks, as well as new stocks being discovered which were previously ignored.
All right. Let's also talk about the fiscal deficit target, which has been lowered to 4.9% of GDP. Earlier,
Yeah.
it was around 5.1% for FY25 during the interim budget. I want to
Mm.
understand what does it mean for the economy and will the government be able to do it?
Yeah. So I think the government is in a very good position to actually achieve this, and they are able to do three things together, which is very rare. They're able to do government capex, they're able to control decrease their fiscal deficit, and they're able to increase their exports. Right. So uh, these three things coming together gives them a lot of room to actually achieve this number. We have to remember that there was hardly any announcement against divestments of government PSUs, and a lot of the PSU rally was on the back of possibly further privatization. But what these mean is that the government is now noticing that they can increase the efficiency of these PSUs
Hmm.
a lot more than just selling it off, and they would rather earn the dividend out of that income rather than sell the asset completely, right? So therefore they have more dividend income like they got from RBI. They
Hmm.
have obviously increased their tax collection base. They are incentivizing formalization of the economy with the various employment schemes, which will force at least the employees to ask the employer that, can you not enroll me into EPFO so that I get this benefit, right? And the employer, if
Hmm.
it's large employer, they will be forced to do it. So that means more formalization, more tracking of employment data, which is and hence more tax collection. At the same time, they have made sure that the basic capex program is maintained. We know that JP Morgan bond index inclusion is coming. There'll be external commercial borrowing. So in that sense, the
Hmm.
government is in a very good spot. It's kind of unfortunate that the total long term capital gains tax collection is very small compared to the overall tax collection scheme, but they still went after it in the short term and long term capital. I don't think it really came from the point of view of tax enhancement, but it came from the point of view of discouraging access, where they felt that perhaps a lot of people are losing money in the markets, and hence they should not trade that often.
All right. So let's now move on from the budget topic to US. I want to understand what are the reasons behind the recent surge that we saw in the Philly Fed index. It
Yeah.
has gone from negative 30 to plus 13. Now, it has also surpassed the Reuters poll prediction, and I want to understand what does it mean when it comes to inflation, the US dollar, and what is the connection of this index with India?
Yeah, so Philadelphia Fed, like there are 7 or 8 Feds that produce different kinds of metrics. Philadelphia Fed
Hmm.
or Philly Fed index is a business sentiment index, and it was negative, right? And from negative in March, it jumped all the way to positive 13, from negative 30 to
Hmm.
positive 13 in a matter of few months. That just means that businesses are very optimistic. What we are not seeing is hiring uh, being that aggressive anymore in US. So you have diverging signals, and generally the start of every recession you get diverging signals, and the start of every bull market you get diverging signals, because
Hmm.
things don't line up. So my read here is that maybe the economy of US is softening, and given that the bond yield curve, the shorter end was higher than the longer end, meaning there was an inverted yield curve in US. I think that potentially we could see further softening of the economy. Again, like the economy numbers are pretty strong, so from here to go to recession will still take few quarters, but things can move very quickly in US. So if that were to materialize, right, and US dollar has been pretty strong, US dollar weakening would further mean that the margin compression of exporters in India, and mostly the IT services company. I've been saying that IT services is not an attractive sector, but in the recent they have done pretty well on the back
Hmm.
of strengthening of dollar, which came from higher than expected inflation data and perhaps rate increases. But these we have to look at these signals. There might be short term pullbacks on a long-term
Hmm.
trend. But overall, if the dollar were to weaken, that really affects the IT companies, especially ones that are linked more to US dollar revenue from US.
Okay. If we talk about UK, the situation in UK is a little bit different. Retail sales in UK are declining, and as you mentioned about divergence, this is also a, a divergence, and I want to understand that what is happening in UK right now, and is it going to affect other economies as well?
Yeah, I was looking at, I mean, European data as well. Europe is not also looking that great. What we are seeing
Hmm.
is that UK, we saw a recession, like continuous negative growth of GDP. We're seeing falling
Hmm.
retail sales. Essentially, the bottom line is, what is that UK is making that the world wants to buy, right? Otherwise,
Hmm.
what is the purpose of their, more than precious currency? And therefore, I really worry a lot about what is that UK is making that the world
Hmm.
wants to buy, and whatever they are selling, most of, let's say, a car like Land Rover, which used to be, or Jaguar, which used to be iconic UK brands, they're now owned by Tatas. Similarly,
Yeah.
there are many businesses that are owned by multinationals. Ultimately, for a country to flourish and for their currency to remain strong, they must produce things that other countries want. And if they're
Hmm.
not able to do that even in their own country, it's a serious problem. But UK is very, very innovative. They are very agile, they are very smart country. So we have to see how they wrangle with the situation. But at the same time, right now things are not that great for UK. So I mean, definitely looking at the currency volatility of GBP versus USD, and definitely looking at these kind of macro indicators which are not looking great for UK right now. So we'll see. Once the new policies are announced by the latest government, how the things pan out, because it's a labor government. They'll protect they will definitely control inflation. So they will make sure that prices are not don't become unaffordable, and they will
Hmm.
control land and jobs and so on in terms of foreign access, which is what perhaps is needed to keep things afloat. So in that situation, we'll see what kind of eventuality happens.
All right. The next thing I would like to discuss with you is about India's FX position. Now, India's foreign exchange reserves have surpassed $660 billion. And if we talk about China, China's stand at $3.2 billion. Now,
Brilliant.
despite China's trillion dollars, my bad. So, despite China's GDP being more than six times of India's, India seems to be in a better position when we talk about the FX
Yeah.
position. How does it affect the markets in both these scenarios? Is it positive or negative? What is your stance on this?
So, I mean, China is one country that has been steadily reducing their US Treasury exposure, right? So, China right now is at the current, they export more than they import, so they have a surplus, which means if they
Hmm.
want, they could have made this basket much, much larger than what it is now. So, it's a conscious decision by the country to limit the forex reserve to this amount, right? And
Hmm.
in India is, just on the cusp of basically becoming a current account surplus country. In some months they are able to do it, some months they're not. But
Hmm.
essentially, the ambition is that we produce things that the rest of the world wants. So we earn more dollars than we have to give away to import things that we don't produce, like oil. And we are trying to, desperately move away from oil to reduce our import, and well as like linkages, right? So
Hmm.
So in this context, India could soon become also a pretty large surplus country. So the question really is that why is China not holding more US Treasury, and why is India holding so much US Treasury right now? So I think what we'll see over a period of time is, as we transition,
Hmm.
we will not perhaps grow the US Treasury, sorry, the reserve basket that much. The excess
Hmm.
dollar might be used to intervene in the FX market to control the volatility of the INR USD, because they want INR to become also a respectable and reserve currency where people are okay to hold INR because the value is not changing that much. In that
Hmm.
context, I think therefore, uh, what that means is that we'll see more and more stable rupee than unstable rupee or volatile rupee. One of the things that we discussed before, which happened, was that RBI came very hard on being able to trade FX options. Basically, what was happening is that traders understood this sooner, and they were just
Hmm.
buying out of money options, selling out of money options, and because there was hardly any volatility, they were just earning the premium at the cost of maybe a actual hedger. So what that meant was that again, like coming back to the macro issue, right? What the regulators and government want eventually is that if whatever money that we make uh, by doing our jobs or doing any business, if they
Hmm.
would rather that money we spent in consuming in India to support the Indian economy. But what was happening,
Yeah.
as you saw, like when you have an open market, others sees
Hmm.
opportunity that allow them to collect this revenue or money from the market and take it to their home country and so on. So I think from that perspective, it's a good move. But again, we have seen that open economies and open policies tend to do better than closed ones, because people feel that they can come in and out anytime without any consequence. But if we keep
Hmm.
tweaking policies too often, that feels that I might be able to get in today, but when I'm getting out, policies might be different.
Absolutely. So let's move on from the world topics to India. Let's also come back to, as you mentioned during the start of our conversation, you talked about STT. So the day budget was announced, Indian markets reacted negatively to all these changes, whether we talk about long-term capital gains change or short-term capital gains change or STT. But after that, we saw that there was rebound seen in the markets.
Yeah.
Now, I want to understand, even after such negative reactions and an increase in these taxes, markets rebounded. So why is that happening, even after tax changes, such big tax changes? And how should investors go about this thing?
So, firstly, I think there was a lot of money sitting on the sidelines waiting for the budget to get announced, to
Hmm.
get over the event. Second, the time of the month was such that where there's a lot of SIP inflows just the beginning of the month,
Hmm.
coming in towards the end of the month. People tend to do SIPs post 20th roughly. Many of the SIPs go around that time. So that was the second, and third is obviously there is this aspect that because long-term capital gains tax is deferred taxation, that means that people are more likely to stick more with the rally than book out early, because the short-term capital gains tax has increased and the long-term has increased. So that makes the
Hmm.
money that has already gone into the market stickier. On back of this, I think people decided to come back and step into the market. But the move wasn't that much. It was of
Yeah.
course something, but it wasn't like that much, and it was not a very sustained move. So maybe it was just a sentimental reaction of people just pulling out as soon as the tax for LTCG and long term was announced. It's just people were perhaps not so happy to hear
Happy.
that news.
Well, all right. Let's get to the last part of our session today. After the budget, which sectors do you think could perform better? And if we talk about PSUs and railway stocks that are not doing good at all. Now, on the day of the budget announcement, energy stocks, solar stocks, jewelry stocks were up. Now, we all know the reasons behind the rise in these stocks, but I want to understand a general situation when it comes to different sectors in the markets right now. What should investors do?
I think more brick and mortar, right? I think more like real things which are including manufacturing. The only nebulous thing that is still attractive is financials, where basically they collect whatever is happening good in the economy, right? So whichever
Hmm.
sector is doing well, they tend to proxy that the most. And the main thing about financial is that it's a collective
Hmm.
thing, both of private markets as well as public markets. So
Yeah.
financials is
Yeah,
a
but banking
proxy.
is not doing great ever since the budget. Even today, the banking stocks are under pressure. So, what is happening in that sense also?
So banking stocks have been under continuous pressure. I think what we are seeing is some sort of a rise in NPA, right? And therefore,
Hmm.
that was already kind of hinted at by RBI, where they were had some concerns on unsecured lending. Banking stocks, they are value stocks. They are hard to price accurately. They always trade at a discount of their fair value because banking
Hmm.
balance sheets are opaque. The business models are not clear. So a lot of opaqueness in the banking stocks, and usually they trade at a discount to what should have been a fair value had it been a very simple and transparent business. Therefore, they are always considered to be value stocks. But that said,
Hmm.
uh, you know what you're observing, that banking is still not picking up, I think that is perhaps based on the fact that if inflation were to come down. So if you go back to the long term capital gains tax argument, right, for people to be tax neutral in 3 years on the long term capital gains tax of 12.5% versus sort of indexation approach, our inflation has to be below 4%. Only then the seller benefits. Otherwise, it's
Hmm.
basically they're paying more taxes. Now, if you believe that uh, the government is trying to simplify and reduce tax burden, perhaps the government feels that they can bring the annualized inflation below 4% very quickly. If
Hmm.
that were to happen from where we are, there's a 20% drop in inflation. When inflation is going down, it's usually not very expansionary for the economy, right, which is what the financials collect. So I think some of the reaction that we are seeing in the financial is this confusion that is it just the government kind of hogwashing a higher tax by saying it's simplified, or is there real intent of bringing this inflation down so that
Hmm.
the customer is basically able to the, the 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 citizen is paying less taxes, the tax burden is reduced. We don't know. Maybe that is the second one is the reason. And if that is the reason, then obviously financials will have to wait a bit, where they can earn more cheap deposits before they start lending out at lower rates.
All right. All right. And any other sectors you would like to tell the audience that will be in focus post budget?
I'm very very bullish on metals and metal related sectors, right? Because there are a lot of environmental barriers now to set up new
Hmm.
capex, especially base chemicals, where some of the chemical companies of India are market leaders in that particular segment. Those kind of manufacturing businesses, pharma APIs, and so on. So anything which is real, atoms are going to be more expensive than bits in a way.
All right, all right. So we have reached the end of our segment for today. Thank you so much, Mr. Abhishek, for joining us today on ET World View and talking about world markets and Indian markets only on ET Markets live stream.
Thank you very much for the opportunity, and have a nice day, a nice day to the audience.
You too, you too. Thank you so much, everyone, for joining in.
Thank you.